During a bull market or strong uptrend, you can generate significant profits. But if you just blindly follow a buy and hold approach through a bear market, it's very likely that those gains will disappear. So, when the stock market goes into correction mode, it's best to protect your hard earned capital and go to cash until things improve. Time and time again, we've seen that it's important to follow the stock market's lead and not fight the trend. History shows that 3 out of every 4 stocks move in the same direction as the major stock market indexes, either up or down. So, when the major indexes are undercutting key levels of support and showing serious distribution, you must take the hint and get out of harm's way by scaling out of your positions. On the flip side, when the market begins to turn around and the indexes begin to rally, it's equally as important to take the hint and scale back in a measured and methodical way, of course. But what exactly does this mean? IBD's Mike Webster has developed a checklist of measurable items for knowing how and when to scale back in. So here's a brief overview of the checklist. We start with the first step of getting a follow-through day. This is the first signal that the indexes are coming out of correction mode and maybe starting a new rally. For a quick refresh on the basics of a follow-through day, here's how to identify one. We must first look for an attempted rally. Day 1 of the attempted rally begins when a major index closes up from the previous session. Neither volume nor the size of the gain matters. The only thing that matters is the attempted rally stays alive. For the attempted rally to stay alive, the index cannot undercut the low of day 1. On day 4 or later of the attempted rally, the Nasdaq or S&P 500 must deliver a strong gain in volume up from the previous day. Backed by rising volume, that big gain, usually a minimum of 1% or 1.25% depending on market volatility, is the follow-through day, which confirms that a new uptrend is underway. Now, once we've gotten that follow-through day, we don't want to go all in, especially if the major indexes are still below key moving averages. We must scale in incrementally and use these critical levels of support and resistance to tell us where to scale in more or back off. This is because not all follow-through days work, especially in choppy and volatile periods or after a severe and extended bear market. The market may have multiple head fakes or unsuccessful follow-throughs before establishing a strong climb. This is why a subsequent follow-through day is just another good signal that the initial follow-through was legitimate. For more on the next several points on this checklist, here's Mike Webster to explain.
Yeah, they don't always go order in this order, but generally they do. So we've got a follow through day, the first thing. So we got that. Then a subsequent follow through day, we had that. Close above the 21-day EMA, exponential moving average, we got that. The low above the 21-day, that's a big deal for me. We got that. So I wanted to just simplify, things as much as possible so you can kind of just know, because there's so much emotion in the market, right? Especially after we had a bear market crash. Everyone thinks of 1987, 1929 when you hear the words crash, or you think of the flash crash that we had about 15 years ago, give or take. But this was a crash, what we had, and so that threw everyone off emotionally. Bulls, bears, if you handled it well or you handled it horribly, still there's FOMO involved, there's fear, there's greed, there's hope. So that's when you want to just go to black and white rules and just say, okay, where are we? So low above the 21-day for 3 consecutive days and closing up. That's a big, big, big deal for me. That's kind of like a deal breaker. Like, unless you get that, you're not really even starting to get out of the woods. We got that. Close above the 50, low, check. Low above the 50, holds the 50 for 3 consecutive days. The next one, that's the big deal, the close above the 200-day. So we've got to get there, but really 3 consecutive days, jumping ahead, but 3 consecutive days with your low above the 200-day and closing up, that's when like, okay, this one might be for real. Because lots of times when you get up to the 200-day, you have everyone watching it as well as computers. So you have algos who are up there and saying, okay, I'm going to short this market because it's at this level that it should roll down. So you're going to have a lot of volatility in a typical market environment. So that's why I like to wait for 3 days or more where your low is above it and you close up. Then the moving averages starting to cross above each other. That's the last thing you'll get, like the 21 day above the 50, 21 day above the 200, and then the 50 above the 200. And it's also something I forgot to put the power trend on there when I was creating this, so I'll recreate it. And if no one, if you're like, what is this power trend I hear about? It is. I'll simplify it. You want your low above your 21 day for 10 consecutive days, and your 21 day above your a rising 50 for 5 days, and that's pretty much it. And then that kind of changes the tone of the market, and that's where you're pushing hard.
Now, we're not saying that investors should wait until all of these are checked off before you can start buying again. This checklist provides a gauge for how far you want to put that gas pedal down at any given moment. As we check off boxes on the list, it makes sense to gradually put a little more money to work as new individual stocks provide those buying opportunities. These are the big picture signals that we want to see as the market improves. You can always come back to this checklist after a crash or correction to get a sense of when it's logical to incrementally put money back to work again. As always, make sure to manage your risk every step of the way.